into our data. Let's go to the next slide. Right, so as the economy kind of sets here, right, so we're in a place right now where interest rates are kind of where they're at. Inflation is sticky. We've got the economy that's expanding at 2-ish%. Large federal deficits are counteracting monetary policy, and really, so the 10 years at 4.2, it's up from 3.6, but at least it's down from 4.7. The labor market's still kind of tight for demographic reasons. We're going to need productivity increases because now with lower immigration coming in, there won't be a large supply of labor holding that piece of inflation together. We also have a structural housing shortage, but because of that, inflation is actually kind of the long pole in the tent of the entire kind of mix. About 30 to 40% of all the components of inflation are in the CPI or PCE are still rising over 3%, but housing is one of the bigger ones, which is in a sense tied to interest rates. And so we need to see inflation come down further. Quite frankly, everyone I've spoken to is that really the inflation target's not 2, it's more like 2.5, 2.6. So we're not too far off, but we're not at a place where short-term rates will come down, and because of the GDP debt to GDP ratio, it's hard to see long-term rates coming down, and therefore mortgage rates coming down. Tyson?
Thanks, Jeff. So the self-storage sector has had 2 pretty challenging years, the last 2 years, with rapidly declining rent, occupancy, revenue, NOI growth, all down from all-time highs in 21 and 22. And this poor performance has mostly been cited as due to weak demand from the housing market. We do see kind of an inflection point happening with advertising rental rates, which have been down year over year for about 28 straight months, but a big improvement at the end of the year and going into 2025 from negative 4.2% in June last year to negative 1.2% in January. And this was really led by the REITs, who have been increasing rates month over month. I'll get into that later on in the presentation. Also supply, although supply was high in 23 and 24, we do see supply dropping by about 15% next year, or this year, 18% next year, and 8% after that, which should be a great tailwind for the sector. A lot of reasons why supply is dropping. On the transaction market side, there was about $5 billion of storage sold last year, which was down 11% year over year. But actually, in the second half of the year, you saw a 50% increase in transaction activity versus 2023. So I think that momentum is going to carry on into 2025. There's certainly a lot of capital out there available for self-storage, some large funds that have been raised. And I think we'll get into the REIT results in a moment, but they were pretty pessimistic because the housing market isn't really anticipated to be a boost for performance this year, probably not for a few years. But I do think occupancy is starting to bottom, and we should see some tailwinds start to form. Getting into the REIT Q4 REIT results and the outlook for 2025, which came out last week. REIT revenue and NOI growth decelerated every quarter of 2024. Performance really varied by company. On average, this was due to a combination of a decrease in occupancy and rental rates, although one company, Extra Space, actually saw an increase in occupancy in both their same-store pool and Life Storage same-store pool. All of the REITs have also experienced pressures on expenses and margins, with outsized growth in property taxes, property insurance, and marketing costs leading the way. However, most of these companies, as I said, believe that occupancy is bottom or is at least stabilizing, which should give them more pricing power in 2025, and our data definitely confirms this, with asking rates actually improving early on in 2025, which should take pressure off achieved rates and provide some backdrop for some revenue growth. Although there appears to be little hope for the housing market in 2025, I do think there'll be less of a tailwind from the decline in occupancy and new supply. And there's little change from last fall from the opportunities in the sector. Many of the markets that have struggled the most with supply in the past year will continue to struggle as their inventory grows. And these are the same markets that really rely on migration and population growth to absorb that new supply. On the other hand, there are a number of more slow growth markets that have already seen a modest turnaround in performance. And there are a number of markets that have seen supply kind of drop off a cliff, which has led to some rent growth recently in these markets and advertised rates. In addition, we are covering a lot of smaller markets outside the top 50, and these have been somewhat isolated from the pricing wars in the top 50, which are the REIT-dominated markets. And these properties also and markets usually offer a heavy discount on price per square foot, so some good opportunities kind of outside the box there. Yardi Matrix continues to expand our coverage into these areas, so keep an eye on performance in those areas. Although there hasn't been much distress to date, it is something that we're continuing to keep an eye on as the peak years for fundamentals saw record high deal flow and development activity. I'll turn it
thanks,
back
Tyson.
over to Jeff.
Yeah, I appreciate that. Let's go to the next slide. So when we think about kind of where the economy lays out, I'm kind of thinking we're bouncing at this 2%-ish GDP. It's going to be very noisy, as we'll kind of get into. And inflation, the GDP deflator, looks around 2-3-ish. Now, there's different ways to measure inflation. You also have the CPI, which is the headline number. That tends to be a little bit higher. The PCE tends to be kind of in the middle, and the GDP deflator kind of at the bottom end. So if you look at these metrics, they're all anywhere from 2.3 to 2.9. So you're basically bouncing around in that level, and I think that's where we're kind of at. And when we talk about the administration's policies, there are deflationary components and inflationary components, and it's mostly the timing back and forth of these of which ones kind of come in first. So when it comes to unemployment, we're kind of again bouncing in this 4-ish% range, and I think it may come down a little bit in 2026. The bond yield obviously is all over the place. It's already at 4.25 versus 4.75. We kind of had a move back, and that first move from 4.75 to 4.25 seems to be driven by assurance that Bessent has provided to the market that he's not going to change the term distribution of financing. He's not going to lengthen it, and therefore put pressure on the sort of 10 and 30 year, and that's kind of brought it down 50 basis points. So I think we really would like to see it at 3.5-ish. And that really, I think, does depend on resolution of the bend of the curve of the debt to GDP ratio, which there's more to come on that. And so I still think the Fed funds number looks about right in terms of its trajectory, with the 10-year being the sort of the one that's a little more problematic. Go to the next slide, please. Again, as I've mentioned before, this when you look kind of peel out shelter really is the long pole in the tent. And shelter, if you look at it, is basically driven by renewals and rent renewals, and that's bouncing around 4%, and that's pretty darn stable. It's even in places like Austin, where there's a ton of new supply on the multifamily side, it's still bouncing around 1 to 2%. So shelter being sticky-ish. If you have movements anything further, it's going to have to be in other elements of the entire sort of basket of goods and services. And that's going to be a little tough. Again, I think 2.5 is reasonable. 2 just ain't going to happen. Let's go to the next slide. And then you kind of look, this is the trajectory that we follow. If you look at advertised rents, again, the reason we're looking at this is that rents heavily influence the shelter component of CPI and PCE. At PCE, it's 25%, CPI, it's 34%, and therefore the overall path of inflation. Let's go to the next slide. Now, when it comes to the good side, these supply chains, at least from a perspective of where they're going, are pretty much kind of back in place. Raw materials kind of popped up a little bit. You also have a significant amount in January and appears to be in February of people rushing to import, which is going to look at the GDP numbers are going to look pretty nasty because those are negatives from a GDP standpoint, a surge of inflation of imports. I think that's kind of a timing difference. You're going to steal growth from future quarters. So I don't think it's going to be that bad. And let's go to the next slide. But you still have this reshoring of productive capacity, and that reshoring or nearshoring, whether it's going into Mexico or the U.S., it was going to more into Mexico. Now the Trump administration would like to be more in the U.S., is inherently not disinflationary. Let's put it that way. And so if we look at the policy mix, before I turn over to Tyson to get into a little more other components of demand, the policy mix for the administration is very much a driven of some deflationary components, deregulation, a reduction in government spending. Those are the deflationary components. The inflationary and deregulation. The inflationary components are reduction of immigration, which would tend to raise wage rates, particularly in construction trades and skilled trades, combining with the reshoring part, which is also going to put the demand on skilled trades, and tariffs, which is they're on, they're off, they're on, they're off. And so the question is it being used as a lever to reduce tariffs globally, or is it designed to protect domestic manufacturers and increase sort of the ability of domestic manufacturing to occur? That's still playing itself out, and the administration is pretty good at a lot of head fakes. And so it's hard to say exactly how this all plays out, but there is definitely a push-pull here. I am, to a certain extent, betting that it's going to level out, but a miscalculation on either side could push inflation up higher than had been anticipated. But I do think the administration would tack backward before things got out of control. So, Tyson, I will turn it over to you to talk about factors related to demand. The one item before we kind of do that is I would say there's a question I think came in about construction costs, right? Is that fair enough?
Yeah.
And its impact there. And what I would say is if the tariffs, particularly on steel, truly come into play and actually are in place for an extended period of time, that would no doubt increase construction costs in a rather meaningful way. Whether that actually happens is, quite frankly, up to negotiation, and the administration is particularly fickle at showing its hand. So I think that is just a known unknown. And now I'll turn it over to you, Tyson.
Great, thanks, Jeff. So we're going to do a deeper dive into storage demand factors this year, as they seem to be on everyone's mind. Starting off with population growth nationally, which continues its long-term cyclical decline due to demographics and low birth rates. According to the census, population growth decelerated to 0.4% in 2024, which is down from around 1% at the turn of the century and long-term average. CBO numbers attempt to include immigration and are higher in recent years, closer to this average 1%, but both sources project growth continuing to fall year after year over the forecast period. And I think this will mean less demand for storage over the next few decades than in decades past. Immigration until recent years has helped make up for the demographic decline, or in recent years make up for the demographic decline, but it's unlikely to be a driver for self-storage demand in the near term and is really plagued with uncertainty at this point under the new administration. As we all know, population growth has impacted different states differently, but been most noticeable in the Sun Belt. Although nearly every state grew in 2022-23, the bigger story here is migration, and recent data shows migration reached an all-time low in 2023, with only 1 in 13 Americans moving homes. And this fact was no doubt lost on self-storage operators, which rely on the steady movement of people for demand. Housing data highlights this point as home sales as a percent of households dropped to a 30-year low in 2024. Early data from 2025 shows little improvement, and Moody's forecast projects more of the same throughout the year, with sales not returning to their 25-year average until 2027. A major reason for the decline in home sales is record low interest rates seen during the pandemic, which was followed by a major increase in rates starting in 2022. As of Q3 2024, over 55% of mortgages were below 4%, and 21% were below 3%. And compare that to today's 30-year mortgage rate of 6.7%. These are the so-called golden handcuffs that have locked people in their homes and froze the housing market altogether. And we think there's little relief on the way. Here you have Moody's projecting that 30-year mortgage rates will remain high, over 6% for the next 10 years. High mortgage rates relative to the past decade have also created an affordability crisis in housing, with the average mortgage rate soaring above average rent, which has been a positive for apartment owners. And the affordability crisis is further demonstrated in this chart here, which shows home affordabilities at a 30-year low, which corresponds with the home sales being at a 30-year low. This has already been an issue for many of the least affordable housing markets shown on the left here, many of which experienced the highest outmigration when mortgage rates were at their lowest during the pandemic. But there's also been a growing problem with a decrease in affordability in many of the high growth markets on the right on the table here. Although there are still many, mostly Midwest and Northeast smaller markets where housing is still affordable, all of the top 100 MSAs have home affordability below their long-term average, which is yet another reason for the freeze in home sales. There are still some markets where home sales are occurring, notably in the Mountain West, Idaho, Utah, and a few of those smaller, more affordable markets in the Midwest have seen some movement in home sales. And this really helps with self-storage demand in certain markets where there is movement. As of Q4, there were also a few markets where home sales had increased year over year, which is a pretty interesting stat. This includes many of the markets that were on the previous slide that had seen the most home sales as a percentage of households. On the other side of the housing market, apartment rent growth can also be an indicator of self-storage demand. Although many of the markets on the right are dealing with more so supply than demand issues. New York and New Jersey stand out here because they've seen stronger self-storage performance recently, which corresponds with strong apartment markets. And then lastly, I want to cover the Google search trends data for self-storage, which I think can provide some valuable insight into self-storage trends. This data shows search volume for self-storage relative to the peak, which occurred in July 2021. Self-storage demand is highly seasonal, which is why we've included the trailing 12-month average on the chart here. Search volume has declined steadily since peak, dipping below the pre-COVID level in 2024. However, more recently, searches for self-storage have picked up, which could help explain a sharper turnaround in rate growth more recently, which I'll get into. It's tough to say if this trend will hold. I think we need more than just a few months of positive results to call it a trend, but I do think it's interesting. This data can also be extrapolated at a market level, which can help uncover some of the markets that are outperforming. This table here shows top 10 markets out of the top 30 in trailing 12-month search volume and trailing 12-month growth year over year. Interestingly, the Pacific Northwest and Chicago were recently called out by REITs as showing above average growth, and you can kind of see the backdrop for that in the Google search trends. And this slide shows the lowest trailing 12-month search volume and year-over-year growth. Meanwhile, Atlanta, Charleston, and San Antonio have all been very difficult markets for the REITs, and the Google search trend data definitely shows this. So now getting into the same store results from Q4 from the self-storage REITs. Average quarter end occupancy year over year for the four public companies kind of bounced around in the second half of 2024 after 4 straight quarters of improvement. Overall, though, the 4-quarter moving average occupancy was flat, which I think may be an indicator that occupancy has finally bottomed. Although revenue growth has continued to decline quarter after quarter and is well below the long-term average of 4.3 for the sector, revenue growth was negative for the full year, averaging negative 1%. Meanwhile, expenses as a percent of revenue have remained elevated, up from historic lows at the end of 2022. The increase in expenses and property taxes and insurance was particularly painful in Q4. And this means NOI margins have come down to around 73% from a high over 76%. And REIT guidance from last week calls for more of the same increases in expenses and decreases in NOI in 2025. Occupancy trends vary by market and range from down 2.5% in Dallas to up 4.5% in Tampa, where demand surged at the end of the year due to 3 consecutive hurricanes in August and September. Other markets that saw an increase year over year in Q4 are a bit surprising given the high levels of supply in recent years, including Philadelphia, Orlando, and Phoenix. And then before we get into the Yardi matrix rent data, this chart compares quarterly realized rates for the REITs to REIT and non-REIT asking or advertised rates. Although this may be a different mix of properties and markets, I do think it shows the impact of lower advertised rates on realized rates in recent years. Although the REITs have really touted the success of using low introductory rates to stabilize occupancy in recent years, it has had an impact on actual rental rates and overall revenue growth, despite the more frequent and larger existing customer rate increases, particularly in 2024, where you can see realized rates starting to come down. So just a reminder of the markets that we cover, and the top markets and secondary markets we'll focus on the remainder of the webinar. We're currently covering the largest 240 MSAs in the country, and over 35,000 self-storage properties, which includes our pipeline. We've been hard at work to expanding our coverage, adding counties to existing markets and opening new markets over the past several years at a rate of about 3 per month. And although we've just begun coverage and we won't cover many of these new markets in this presentation, I wanted to quickly just highlight a few of these that I think make for interesting investment targets. Out of the 35 markets we've added the past several years, these have the highest rents and population growth, lowest average 5-mile saturation or supply per capita, and the most exposure to new supply. Although a few of these markets have strong rents or demand characteristics, new supply could impact performance in a number of these markets, like Athens, Georgia, Port St. Lucie, Florida, and Appalachian, Virginia. And we'll continue to expand our coverage in the long term, going down the list of the largest metro areas and counties in the country, this list showing the pipeline for market additions. As of January, annualized rents per square foot for the top unit sizes for around 25,000 properties that were surveying monthly averages $15.36 for non-climate controlled units and $17.81 for climate controlled units. Rents are noticeably seasonal in self-storage, have really been falling from their peak in July 2022, but rate declines more recently have been slowing. Same store year-over-year rent growth for these properties was negative 1.2% in January, which was a noticeable improvement from around negative 4% for most of 2024. Rate declines have been more pronounced for climate controlled units than non-climate controlled units, which is due to more new supply of climate controlled units. But recently that difference in growth has tightened. Looking at month over month growth over the past few years versus the 2017 to 2019 average provides more insight into these seasonal patterns, as well as highlights more recent trends in rate growth. After years of slower than typical month over month growth, advertised rates actually improved in December 2024 and 2025, which is potentially an early sign of an inflection. A big part of the story here behind these advertised rates decline is the sharp drop in asking rates by the self-storage REITs, which manage nearly 35% of the total supply. Private operators have been slower to change their strategy and have held rates 6 to 13% above the REITs in the same markets. However, the biggest change since the last webinar has been a reacceleration of advertised rate growth by the REITs. After years of lower rate growth, year-over-year growth rate for the public operators surpassed private operators in Q4 and approached 0% by January 2025, so keeping rates pretty flat from last year. Growth rates are noticeably different by company, and Extra Space and Public Storage, the largest operators, has shown the biggest turnaround in growth in recent months. Yet new supply, I think, continues to be a drag on rate growth overall. And this chart shows advertised rental rates for properties by year built. Operators typically use lower rates to fill up new stores, and this trend has become more pronounced in recent years as more new supply has been delivered and lease-up properties stall on their lease-up pace. As of January, rental rates for properties under 1 year old were 18.6% below rates for properties operated for 3 or more years. At a market level, a number of markets are starting to show positive rate growth after years of decline. This chart looks at the impact of new supply and demand factors, specifically population growth and apartment rent growth on the top 30 markets. Markets in the top left quadrant struggle with above average supply and lease up and below average demand. And this includes Atlanta, which has been the lowest performing market on rate growth for years. Markets in the bottom right have below average supply and above average demand, and includes 5 markets that saw rents up year over year in January. In ranking these top 30 markets on rent growth, Washington, D.C. appears at the top, which helps to explain why it was CubeSmart and Public Storage's top market for revenue growth in the fourth quarter. I think there is some uncertainty in D.C. with job cuts, and it'll be interesting to see what impact that has on the local self-storage market. Tampa, again, has benefited from hurricane related demand. On the other hand, many of the markets on the right, at the bottom of the list, have been impacted by new supply and or weak demand trends recently. However, all the top 30 markets have actually seen rent growth accelerate versus a year ago, which is a very positive sign, as nationally rent growth has improved from negative 3.3% in January 2024 to negative 1.2% in January 2025. Most secondary markets on this list have seen even stronger demand trends than the top 30 markets, although many of these also have supply issues of their own. Particularly White Plains, New Jersey, and Southwest Florida have had supply well above the national level, and as a result have seen below average rent growth. Despite strong population growth and home sales in recent years, Boise has managed to avoid a major supply wave, and this is really benefiting rent growth there. Surprisingly, New Orleans posted the strongest rent growth out of the secondary markets, with rents up 1.5% in January. Despite a strong apartment market, most suburban New York markets have been impacted by new supply, as developers have really shifted focus from the 5 boroughs.
Hey, Tyson, I'm sorry,
yeah.
but before we get too far away from the demand, there was a question about what percentage of demand is, commercial versus residential.
Yeah, sure. So the Self-Storage Association produces a really interesting demand study every few years. And I used to hear from back from my days at Heitman that you'll see anywhere from like 20 to 30% demand from commercial users and 70 to 80% demand from residential users. So one of the benefits of self-storage is you do have so many different demand factors. And even in the face of a 30-year low for home sales, you still have demand coming from different various sources. Looking outside the top 60 markets that I just covered, in the remaining markets, which is about 110 additional smaller markets, rent growth has been noticeably less volatile and mostly outpaced the top and secondary markets over the last 7 years. I think this highlights the point I made earlier about the attractiveness of these markets and the impact of the REIT's rental rate strategy on overall rent growth, since the REITs are far less dominant in many of these markets. And lastly, another trend we've been seeing for years is different rent growth by unit size. Rent growth for large units, which is 10 by 20 and above, have noticeably outpaced rent growth for smaller units. And I think this is also due to new supply being more focused on these small units, which offer a higher rent per square foot. And just to summarize, rent growth has weakened the past several years, but is starting to moderate as occupancy has reached a trough. I think we could see advertised rates stabilize more in the coming months, and I think it'll reach 0% for the nation by mid-year, and potentially could grow in the second half of the year. But again, a lot of that's going to depend on the ongoing supply and demand trends. So turning now to new supply, just a
Tyson,
reminder.
just a couple of questions that
Sure.
I just thought I would cut in. Sorry, before we got
Yeah,
so
no problem.
far. One of them was how can operators drive occupancy and revenue growth at newly built and lease-up assets in competitive markets?
Well, I think using lower rates gets people in the door, and also, using kind of the REIT management. But also, I think if you're looking to invest, I always tell people to kind of look where everybody else isn't looking, and the REITs have been really focused on the top 50 markets. I think a lot of smaller markets offer a lot of benefits, and certainly if you're a smaller private operator, you can have more of a say on your rental rates in your trade area market.
Okay, thanks. One other question that we got from the attendee list: will the industry go back to the old pricing models and forget the models that have quicker increases?
Yeah, I think that's a really interesting question, because they've kind of advertised that they're not really changing their models, but I think that they've historically said that they can make up for the gap in street rates versus in-place rates by pushing ECRIs. But I think in 2024 that changed a little bit, and you finally start to see achieved rates come down. And as a result, I think that's why you're starting to see the public companies push street rates to new customers a little bit more aggressively. Also, I think a big part of it was occupancy declining, wanting to maintain occupancy. I think if occupancy continues to remain steady, that you could start to see some growth in advertised rates, particularly going into the busy spring and summer season, and into the second half of the year when you're going to have kind of easier comps from 2024.
Okay, thank you.
Yeah. So just a reminder about the different development stages we're tracking, and we'll cover in this section. Prospective properties are developments that are seeking but not yet received planning and zoning approval. Planned projects have received approvals and not yet begun construction. The number of properties in this group has grown in recent years to over 2,000, as we've added markets, but also as existing projects have stalled, which I'll get into in a little bit. Under construction properties have broken ground and gone vertical. And then we define lease up supply as any property built in the last 3 years. Since that seems to have been the average time to reach stabilized occupancy. But just note that that lease up pace has varied over the years and can be very different by market and trade area. So looking at our supply forecast, one of the most positive trends we're seeing in the sector is declining deliveries after development activity picked up really in 2023 and 2024. 2024, we saw over 66 million square feet built on the heels of 72 million square feet delivered in 2023, which was the third most active year for new construction in the last 25 years. However, development has become more challenging, and in the face of high interest rates, increasing construction costs, and a more challenging competitive operating environment. Supply is expected to drop 15% in 2025, 18% in 2026, and then 8% in 2027, which should ease pressure on rental rates and occupancy. However, we're still working through a lot of the supply delivered over the past 2 years, and I think that'll take some time to absorb as demand has remained muted. Deliveries by month shows the slowdown in new supply starting by mid-2024 and really continuing throughout the second half of the year. And so far into 2025, where we've only seen about 66 or 65 deliveries so far this year, including expansions. But these numbers for January and February likely come up as we discover more projects that have been completed. Breaking out supply by type, an increasing proportion of new supply in recent years has been ground-up developments, as many of the best conversion and expansion prospects have already been built. During the last development wave, expansions and conversions made up more than 40% of the supply being built, but that fell to 38% in 2023 and 27% in 2024. This has likely affected performance since new builds often take more time to lease up, and as we showed earlier, have to do it with lower rental rates. We use the trailing 36-month supply as a proxy for lease up, which we showed on a slide earlier, seems to have an impact on rent growth. Supply and lease up declined from late 2020 to early 2023, but due to the amount of supply activity following this was due to the amount of supply activity following record high performance in 2023. Lease up supply has really flattened in the past 2 years, which really has exacerbated the demand issues that the sector has faced. Lease up supply has varied considerably by market, with the Sunbelt markets that experienced the strongest in-migration over the past several years bearing the brunt of development activity. Las Vegas, Orlando, Atlanta, Tampa, Charlotte, and Phoenix all fall into this camp. Philadelphia had years of outperformance due to very little existing supply, but that changed around 2019, 2020. On the right side of the table, there are a number of markets with the least amount of supply and lease up that have seen a quick turnaround in performance as the supply pipeline emptied out. Denver, Portland, Nashville, and Minneapolis were all at once at the top of this chart, which had devastating impacts on their fundamentals, but also prompted less development activity in recent years and led to a turnaround.
Tyson, how does the new supply, which is typically Class A, impact the ability of B and C properties to raise rents?
I think, storage is less like apartments or office where there's a big difference in the supply by class of property. I think there's definitely Class A has kind of suffered more from competition with new supply, but it's kind of just been across the board an impact on rate growth. And actually, that's a good topic to look at in future webinars, see if there's been a difference in rate growth by class of property. When we've shown that in the past, there really hasn't been that big of a difference because self-storage is, basically just a room. And I think where the impact has been seen more so is in the climate versus non-climate controlled units, and then large versus smaller units.
Okay, thanks.
Yep. Over the past 3 years, most of the top markets that we've covered has seen a steady decline in new supply and lease up, which is led really by the 4 markets that I just mentioned. Out of the top 30 markets, only 4, Las Vegas, Charlotte, Columbus, and Los Angeles, actually have more supply and lease up today than they did in January 2022. And Columbus and LA still have less supply and lease up than the nation overall. Many secondary markets have seen even more supply and lease up than the top 30 as development activity spread like the population did during the pandemic. Many of these places avoided a major supply wave during the previous peak in new supply in 2018 and 2019, but offer more available and cheaper land and buildings for development. Suburban New York and smaller Florida markets have kind of taken the baton from New York City and larger Florida MSAs like Miami as development activity spread out. But there are a number of secondary markets that have continued to avoid new supply, high barrier to entry markets like Orange County and Salt Lake City, and then cheaper rent markets like Oklahoma City and Greenville, South Carolina do not face near-term supply challenges. Another indicator of supply trends is construction loan activity, which really dropped in 2023 and 2024 due to higher interest rates. This chart shows another trend we've been tracking, which is construction loan activity by developer experience. So the number of properties the developer has built in the past 8 years. An increasing number of loans have gone to less experienced developers, including 48% of the loans in 2023 and 59% of construction loans in 2024 going to a developer for their first self-storage project, which is up from 30 to 40% from 2016 to 2021. These less experienced developers may be less savvy to market conditions that have kept most of the most active developers on the sidelines in recent years. And here's a new slide we put together for this presentation showing the percent of supply managed by the self-storage REITs and U-Haul over the past decade. These 5 companies have managed nearly half of the supply nationally, including third-party management in many markets where they don't own properties. This has contributed to the consolidation of the sector. And since they're usually leasing up rates at well below market, lower rent growth has followed the supply wave. And then again, I'll just mention that nationally, about 35% of supply is managed by these REITs. So development activity has definitely contributed to this. Yardi Matrix stays on top of the 3,000 plus properties in the pipeline by checking on the status of development projects every 30 to 90 days. If we receive word that a project has been dropped, we'll change the status to abandoned, still keep it in our database. Although we saw a large increase in abandoned projects in 2024, the pipeline has continued to grow as we've added new projects, although at a slower rate in 2024. We'll continue to monitor this throughout 2025 since it could be a signal for our supply forecast. Of the more than 200 million square feet in our supply pipeline, there has been a noticeable shift in the top 10 markets from top markets to secondary markets to remaining markets in recent years. Much of the pipeline today is concentrated in those remaining markets, including smaller markets throughout the Sun Belt. However, there's still some notable markets on these lists, including White Plains, which has nearly 20% of stock in lease-up, and Phoenix and Las Vegas, which have many projects in the planning stage waiting to start construction. Many of the markets on that previous slide with the most supply and lease-up still have a considerable amount of new supply under construction to work through in the near term, including Orlando, Phoenix, Tampa, and Philadelphia. As a result, I think the rankings for rent growth in the top markets is kind of unlikely to change very much over the next year or two. Although supply and lease-up has declined over the past 3 years, the under construction pipeline has increased in the past year in most of the top 30 markets, led by Phoenix and Nashville. There are a few high supply markets that have seen construction activity fall in the past year, which is good news. This includes Orlando, Tampa, and Las Vegas, and it could provide a boost for rent growth in 2025. Most California markets still see declining development activity, which should help with slower new demand in the state. In addition to supply and lease-up, New York suburbs and smaller Florida markets are still facing a challenge for more supply under construction as well. And many of the markets on the right with the lowest amount of supply under construction are also on the list of lowest supply and lease-up. And lastly, this is a new slide here where I wanted to call out a really well-publicized, but I think often misunderstood metric that's constantly used in the industry. Saturation refers to the amount of net rentable square feet per capita by not nationally or by market or by trade area. But rather than look at total supply in a market divided by total population, I really prefer to look at the average 3-mile and 5-mile saturation for all of the properties in a given market. This is because self-storage supply tends to cluster together due to zoning restrictions. Using this approach, self-storage saturation nationally averages 11.2 square feet per person within 3 miles and 9.4 square feet per person within 5 miles, which is much higher than the 7 or 8 square feet per person you've seen typically quoted. It's also important to remember that self-storage demand has regional variances. So it's always better to compare the saturation trade area level to the local market average rather than the national average. For instance, you wouldn't want to see, for instance, a property in Houston with 10 square feet per person probably isn't going to bother you as much as a property in New York with 10 square feet per person. These tables here rank the top 10 highest and lowest 5-mile saturation by market for Yardi Matrix is 170 markets. There is much higher utilization of space in lower density and high growth markets for a variety of reasons. While again, the Northeast tends to have a much slower supply per capita. And now a brief dive into our recent forecast changes. I'd encourage you to check out our supply forecast notes, which are available for free, which really dive into how we create our forecasts and what we're seeing on a quarterly basis. We saw this last quarter, we saw an increase in projected supply versus previous forecasts, but still a major decrease in supply in the forecasted years versus the last 2 years. Part of the increase in supply is due to us adding markets. And for the markets we've been tracking over the past 2 years, there has been a noticeable decline in construction starts and under construction supply, although that planned pipeline has remained relatively flat. And part of the reason for the flat planned pipeline has been construction delays, which are demonstrated in this chart here, which shows the average days a project has remained in each development stage over the past several years. The time it takes for a planned project to begin construction has ballooned from 340 days in 2019 to 500 days in 2023 and 2024, which I think provides some context for the amount of planned supply really remaining the same. Additionally, it now takes 12 to 18 months for a project to complete once it starts construction, which I think speaks to the difficulty of building self-storage post-pandemic. I believe this is due to material and labor costs and timing, which have increased. And I think this is something that we're going to continue to focus on and will work its way into our forecast. Again, despite the increase in our recent forecast, we believe we still project a healthy deceleration of new supply over the forecast period, which will be a tailwind for the sector in 2025 and beyond. New supply will drop to 56 million square feet in 2025, 46 million square feet in 2026, and 42 million square feet in 2027, with new supply as a percent of inventory well below the long-term average of 4.1%. Forecasts for later years are really subject to change with demand and performance, as well as interest rates and construction costs, which could add to the pipeline.
Tyson, a couple of questions came in about supply. One of them is, why can more dense markets such as New York or Los Angeles not handle the same supply as other markets such as Houston, in the example you gave?
I would say, again, self-storage demand is really regional, and even like within a market can vary a lot by trade area. And that's really due to kind of people moving being really the accelerator for demand in a certain area. So urban areas, they see less people moving in and out relative to the total population, and therefore would have less demand for self-storage. But really all markets have been impacted by both urban and suburban, and Northeast and Southeast have really been impacted by the decrease in migration. And that's why you've seen urban markets kind of outperform, because they have more of a steady tenant base that is less using the supply because they're moving, than places like Atlanta and Florida that's kind of rely on home sales and people moving for demand.
Okay, thanks.
I'm just going to get into some slides here on the transaction activity in the sector, which we're tracking. Transaction volume stabilized in 2024 with roughly the same amount of stores sold as in 2023. Our estimate is that $5 billion of self-storage traded hands in 2024, which represents an 11% decline from 2023 and is just under the pre-pandemic average. However, there was a big difference in the second half of the year, as transaction activity from June through December was up 50% year over year. I think this momentum should continue into 2025, as there's really unprecedented interest in the sector, capital waiting on the sidelines, ready to deploy. Pricing for self-storage varies significantly by property class and market, but overall has come down in recent years from near $170 per square foot in 2021 and 2022 to $130 per square foot in the last 2 years. Lower pricing is somewhat a function of fewer Class A and fewer lease-up properties trading. There's still a big difference in pricing for Class A assets, which are around $200 per square foot, and Class B and C, which have sold for around $100 per square foot. There's also a 50% discount in pricing in the remaining markets that we haven't really covered versus the top 60 markets that we covered in this presentation. Looking at NCREIF data on cap rates, I don't really think this is super representative of actual trades. In fact, most cap rates I've heard recently are kind of in the 5.5 to 6.5 range, kind of high fives is the average. So this is valuation cap rates versus those kind of transaction cap rates. Looking at loan maturities, there's not a lot of loans maturing in 2025, as I think a lot of the loans that were maturing have been extended, and that's why I think you see a pop in kind of 2028 and 2029. Still a third of the loans maturing over the next 2 years are CMBS, and I think a lot of these owners could look to sell properties as their loans come due. Covering some recent portfolio sales here. Actually, estimated portfolio sales volume increased 13% in 2024. The REITs have been particularly active on this front, both buying and selling. There was a lot of activity in the fourth quarter. Again, the second half of the year saw increasing momentum in the investment market. There are also a couple of private owners and operators that have been very active, kind of in less popular markets. So buying properties either from REITs or from smaller owners in markets that REITs are not focused on. So a lot of opportunities out there, and a lot of money out there that's chasing these opportunities. And then lastly, looking at the top buyers, the large private operators like Storage Rentals of America and Prime Storage have been the most active buyers, and actually became the largest private owners in the US just in the last few years alone. The REITs remain pretty active, and there's a number of kind of newer companies that kind of new entrants in the last 5 years that are making a big splash in the transaction market. So that kind of covers it for us. We have just a recap of the opening slides. But I wanted to mention a team of us from Yardi Matrix will be at the SSA Spring Conference in Orlando next week at booth 501. So you can come by and say hello to us. Feel free to ask us any questions about the materials you saw here today, or you can schedule a meeting with Casey. We'll also be at ISS in Las Vegas in April, and have a number of other webinars coming up. And then to make the lawyers happy, we got our copyright notice and disclaimer here. But appreciate you all joining us today, and hopefully you got something out of it.
And nice job, Tyson. You can move back to where the slide is on our events. Hey, Paul, any other questions that we could answer before we have to say goodbye?
Yeah, there's a couple questions about REITs. Would you expect move out rates continuing to increase as customers who are longer term take advantage of lower move-in rates, or are lower term customers more sticky? Another question about REITs about third party management. Do they have a positive difference for performance?
Well, let me take the first question. Is what has made self-storage unique in consumer-facing real estate asset classes is the fact that most folks who are taking storage are really immune to sort of like, what is going on with new rents. Okay, now if the gap is super, 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 super big, then maybe, but it has tended to be a rather sticky asset type because you're not going to move your stuff and go through that kind of hassle for a small kind of change in pricing. If it's extraordinarily big, then that might prompt it, and we may see some of that beginning to happen. But historically, that's what made self-storage such a profitable sector, is this disconnect between existing customers and new customers. Tyson, maybe you want to take the second question.
Yeah, first of all, I just agree with you. I think move-ins and move-outs are pretty steady in the industry, more related to pricing than they are to or sorry, less related to pricing than they are to just kind of natural
kind of lifestyle issues, right?
Need for the space.
Yeah.
What was the second question again?
The second question, there were a couple questions coming in about REITs as property management. Do they make a positive difference? Also, another question about what percentage of properties are non-REIT storage properties are owned by a third-party manager.
Well, that'd be interesting to look at the larger private operators, what kind of percent of the market they are managing. I do think the REITs have really focused on third-party management platforms, and certainly they have an advantage because they have access to in-place rent data. I think there's been a big disconnect between what we track, which is advertised rental rates, and in-place rental rates, which are actually market rates. And that has kind of helped the REITs boost their third-party management platforms because they have the best kind of sense of what in-place rates are. And I see that continuing. I think Extra Space said on their call last week that they had the biggest increase in third-party management properties last year of any year. So certainly the sector is becoming a lot more consolidated. There's a lot of benefits, obviously, to using a REIT manager, but I still think there's a lot of room for private operators, especially the large private operators, to increase their market share and third-party manage.
There's a couple questions about new construction. One of them is, what are the biggest constraints from moving sites that are in the plan stage to the under construction stage in the near term? Is it interest rates and macro uncertainty? What would you need to see to fundamentally start to have a more constructive view of
I
new
think
supply?
now's really difficult time because construction costs continue to increase. Also, a lot of properties that are planned still are looking to get financing, both debt financing and equity financing, and there's been a lot of uncertainty around that. So it's just really all of the above that is kind of keeping projects from moving forward. I have seen a lot more listings for entitled land in the past few years, which I think kind of highlights the point that it's just a lot more uncertain development environment nowadays.
Okay, and then lastly, and I think we've talked a little bit about this at least, what's the impact of new tariffs on construction going forward?
Yeah, and so what I would say is, Tyson knows this as well, is steel is a big deal when it comes to self-storage costs, the cost structure. And so we don't know, and this is, part of the administration's kind of negotiating tactic is that the tariffs are on, they're off, they're on, they're off, maybe they're on. So if they stick, then yes, they will have an impact on construction costs. There's no question. So what we don't know is, are they going to stick and over what period of time? And obviously it takes time because a lot of the projects that are certainly under construction now have their sort of steel needs already met. So you're talking about, again, it's one of that, what Tyson was alluding to, the planned projects, right? In order to get things to move forward, you got to get a handle on what your pricing looks like, both financing and construction and having visibility with the rent, what rents are going to be accomplished. So I can see why there's a lot fewer projects moving from plan to under construction, given that level of uncertainty. This is just one more piece of uncertainty. And so, Paul, thank you very much. I think in the interest of time, we don't want to hold anybody else any longer. If anyone have questions, please reach out to Tyson or myself. And I want to thank you. And Brittany, if you could wrap us up, please.
Sure thing. Thank you for attending our self-storage outlook, a